Commodities rose, but commodity currencies actually fell in emerging markets, which is quite a rare thing to happen. Stuart Allsopp, BMI Research. The Chinese yuan fell to a 6-year low against the US dollar on Thursday. Do you think this is an accurate reading of the strength of the yuan against the dollar? And what do you foresee for the future of the pair following Trump's election victory?
I think it is an accurate reading. I think that the Chinese economy is slowing at a rapid pace, more so than that of the US. I think that the Chinese economy faces further monetary easing. In the case of the US, they're probably going to be hiking interest rates in December, almost certainly actually, and probably further interest rate hikes next year. In the case of China, they have a banking system that requires continued government support and a easy monetary policy, and perhaps more importantly, they've got a property market that's looking very, very bubbly and at risk of bursting. So if that does take place, if the property bubble in China does burst, that means even more monetary easing and possibly outright quantitative easing. And all these factors suggest that the yuan's going to go quite significantly weaker.
Following Trump's victory, investors flocked to safe haven Japanese yen. Do you think the currency is in good condition, and what are the prospects for the Japanese economy moving forward?
Initially, the yen strengthened sharply on the news that Trump was going to win, and then at the victory speech, risk assets really, or safe haven assets really reversed. Gold fell, the yen fell considerably. And I think the yen is very at risk because, unlike most of the central banks, the Bank of Japan is very, very reluctant to hike interest rates. I mean, it's not, most central banks don't want to hike. The European Central Bank is going to struggle to hike anytime soon, and so is the Bank of England. The difference in the case of Japan, though, is that if inflationary pressures start to rise, the huge amount of government debt stock that they have means that they won't be able to hike interest rates, because if they do, it'll significantly increase the cost of government borrowing. And given that they're running huge fiscal deficits, this is going to be unpalatable. So, in the case of the dollar, interest rate hikes are likely to be forthcoming, and even though the U.S. government is in a fair amount of debt, it's unlikely to prevent the Fed from hiking. In the case of Japan, the economy remains weak. It's perhaps past the worst of it, but once inflationary pressures start to rise in Japan, it looks like real interest rates are going to go even more deeply negative, and this will undermine the yen.
The Aussie dollar suffered a turbulent few days after the US election, but some large moves in commodity markets could benefit Australia. What do you predict for the Australian economy moving forward?
Yeah, it's interesting because, like you said, commodities rose, but commodity currencies actually fell in emerging markets, which is quite a rare thing to happen. There are positive tailwinds in terms of rising commodity prices, but at the same time, iron ore is one of the commodities that we're quite skeptical on because of the Chinese housing market, basically, and that's a major source of demand for Australian iron ore. So we're not particularly bullish on Australia in terms of trade, despite general upside pressure on commodities. And the other thing is that at the same time, again, Australia is suffering from what we probably call another bubble in the property market. So it probably will mean that there is slower credit growth, very little upside pressure on interest rates, and with the terms of trade unlikely to improve significantly, we think that the Australian economy is probably going to probably going to underperform, and the Australian dollar continue to weaken against the US dollar.
Thank you, Stuart, for your insight and expertise. I'm Jack Everett, and this was the weekly wrap-up. Check back on Monday for the week ahead. Goodbye.